Uber Eats is convenient and profitable, but will it be profitable enough to save Uber? Hey everyone, this is Kevin the Apptrepreneur, and I have spoken not highly of Uber Eats. I think Postmates and Caviar are better for both consumers and drivers for a myriad of different reasons. However, Uber Eats does exist. It is convenient, and if you need something in a quick fix, it works. And I've also talked in detail about how Uber Eats actually helped Uber quite a bit because Uber Eats, unlike the UberX service, makes money. In fact, Uber Eats pretty much keeps the losses on Uber from being as great as they probably could be at this point because Uber loses a lot of money, but Uber Eats is a silver lining, so to speak. Well, there are some business people who are looking at Uber Eats and saying, can the Uber Eats business save Uber? Can Uber Eats carry Uber until ride-sharing begins to work? And the answer that this particular person found was, no, it can't, and Uber really shouldn't be acting as if it can. However, before we talk about any of this, let's have a word from our sponsors.
And today's video is sponsored by Maximo, the rideshare automation app that allows drivers to safely and easily accept ride requests for Uber, Lyft, and Postmates. Whether you drive for a single platform or multiple platforms, Maximo's custom settings can help you drive more efficient, less distracted, and help you maximize your earnings. It will automatically accept one trip, turn off the other apps, and when your trip is over, it will end it, open the other apps, and accept the next trip, all without you having to touch your phone. Use referral code APP60 and get your first month free when you subscribe to Maximo.
This from International Business Times, why Uber Eats won't save Uber. Investors love to talk about Uber Eats, the fast-growing food delivery wing of Uber Technologies. Indeed, the food delivery business looks like a bright spot for a company that is coming off a disappointing initial public offering, faces decelerating revenue growth, and has struggled with brand image problems in the past. Uber bulls believe that the food delivery business will become a substantial profit center and that its rapid growth since the Uber Eats app launched in 2016 shows the power of optionality or the company's potential to be much more than just a ride-sharing company. And I will say this, it does suggest Uber can do more than just ride-sharing, but let's continue. However, there are a number of problems with this argument. First, Uber Eats isn't as strong a business as certain numbers like last year's 149% revenue growth might make it appear. Second, the food delivery segment will always be much smaller than its core ride-sharing business. In order for the company to justify its $74.5 billion market cap and deliver growth, it needs to execute on ride-sharing. So let's go over this and see what their arguments are. Oh, by the way, it looks like Toys R Us is coming back. Uber Eats revenue came in at just $1.46 billion last year, and in the first quarter of 2019, the segment's revenue was $536 million, a 89% jump year over year. However, those numbers don't accurately reflect the real impact of the business's growth on Uber. In terms of adjusted net revenue, a figure that subtracts excess driver incentives or the additional payments Uber makes to its drivers to support retention and boost their income, growth is much slower. Adjusted net revenue from Uber Eats in the first quarter increased just 31% to $239 billion, or less than half of the segment's unadjusted revenue growth rate. Not good. In the fourth quarter of 2018, Uber Eats adjusted net revenue increase was even slower at just 11.5%, even though the unadjusted revenue doubled. In other words, the majority of what appears to be Uber Eats' skyrocketing revenue growth is really just money passing from the customer to the restaurant to the driver. It's never really in Uber's hands. Though Uber Eats bookings are growing rapidly, its ability to keep any of that money is quickly diminishing, which is a problem if you're a publicly traded company. Presumably, Uber is paying those excess incentives because the company believes it's in its best long-term interest to do so, but the need to keep paying them seems unlikely to go away because the rates suck. Uber has been confronted with intensifying competition in recent quarters, especially from DoorDash, which surpassed Uber Eats in U.S. market share last October. According to data analyst firm Second Measure, and now has 29% share compared to 22% for Uber Eats. Grubhub, with a 32% share, remains the leader. And that's because Grubhub, to my knowledge, pays the best of all of them. Well, maybe Caviar pays a little bit more, but Caviar is really not available in many places. DoorDash's surge has come with the help of SoftBank, the same investor that helped fuel Uber's growth. The industry is shaping up to be a battle royale for market share, with companies spending aggressively on advertising and incentives. That's a poor sign for profitability, as food delivery is essentially a commodity business. Yeah, and that's the problem with not only their Uber Eats, but with their ride share. Yes, their business model is built upon incentives and getting new people to come in, because when they drop the rates, they drop prices or something like that, and they want to increase their share, the new drivers won't care, but the old ones will. So get rid of the old ones, take in the new ones. And yet it's a game they do every single year, and you can only spend so much incentive money. Like, I do think long term it would have been wiser, like, hey, you know what? Cut down on the incentives once you have enough drivers, but keep the pay good. Get those people to be loyal to you. Don't make it a constant thing where you are always hiring new people. That's just not good business. But let's continue. DoorDash's surge had come with a sell. Read that one already. Uber Eats made a smart move, nailing down exclusive contracts with chains like McDonald's and Starbucks, but now it seems like they won't pay off as much as expected. McDonald's is renegotiating the deal as franchisees were unhappy with it. The fast food giant may also end the exclusive arrangement with Uber Eats. Either way, the new terms are expected to be more favorable to the fast food chains, as Uber needs it more than it needs Uber. In its prospectus, Uber also acknowledged that it sometimes loses money on delivery for the largest retail chains, understood to include McDonald's, because it charges them a lower service fee. The upshot in the increased competition and accelerating access driver incentives is that Uber Eats isn't nearly as strong as the headline number of 149% revenue growth would indicate. So yeah, that's kind of like their big thing right now, McDonald's and Starbucks. And yet I think McDonald's wants to actually try their own delivery service. It's like, once you kind of do it for a while, you're going like, man, like, we could have people delivering this stuff. Why aren't we doing it? Why don't we have a system? Why are we paying Uber? Now, I think Uber's system is better. Full disclosure. Burger King tried to be a delivery company, and I think that more or less failed miserably. I got it delivered once, and it was not done particularly well. The food was fairly lukewarm, and the driver did not seem very experienced at finding houses and things like that. So it is a process, and one that Uber definitely holds over them. And yet this reinforces the idea once more that Uber doesn't intrinsically have a product. They don't. Anyone else can do this, and they need certain brands, particularly in the Eats area, or else who wants to do Uber Eats if you can't get McDonald's or Starbucks or In-N-Out or any of these certain businesses? Once these businesses go other places, Uber Eats is just an app that doesn't work very well, kind of like MoviePass. So, just a side dish, and this is the big crux of the argument. Investors also seem jazzed about the Uber Eats business because it efficiently builds off the technology in Uber's ride-sharing service and taps into the same driver pool. Uber makes this argument in its prospectus, claiming that Eats helps boost drivers' earnings and complements their business during times like lunch and dinner when ride-sharing isn't at its peak, which is I think that's accurate, I would say. However, demand for food delivery will always be minor compared to the ride-sharing business. Uber itself estimates that the service addressable market for ride-sharing is $2.5 trillion, triple that of food delivery at $795 billion. Innovations like autonomous vehicles would also drastically change the economics of ride-sharing and could therefore lead to a boom in the industry down the road. That's not going to happen. It's hard to envision a similar leap in food delivery. The input cost of the ingredients and labor to prepare the orders will remain the same even if the self-driving vehicles go mainstream. And by what Uber's little testing, you still need drivers for like apartments and stuff to actually pick up the food and bring them to the doors of people. Like, is that what the future of Uber Eats is going to look like if they get these drones worked out? Like, you're going to just have someone standing on the roof of a building like for several hours and then grabbing the food and taking them down, up and down the stairs all day? That seems really weird. So, finally, considering Uber already commands a valuation in the range of $75 billion, it's unlikely that Uber Eats is going to sufficiently move the needle for the stock. Grubhub, the leader in U.S. food delivery, commands a market cap of just $6.5 billion. DoorDash, the fastest growing food delivery app, was valued at $12.6 billion in its latest funding round last month. Even if you attribute a smaller valuation to Uber Eats, the vast majority of the company's valuation comes from the ride-sharing business, so the success of that is ultimately going to determine Uber's, they called it the Uber's future, I just call it Uber's future, rather than side businesses like Eats and Freight. or futuristic ambitions like helicopters, flying cars, or even autonomous vehicles, which could do more to hurt the company than help it by exposing it to greater competition. Uber thus far hasn't demonstrated they can succeed at multiple projects at once. Its autonomous vehicle division hit a roadblock after a pedestrian fatally was run over last year, and its reputation under former CEO Travis Kalanick for skirting local laws and fostering a frat boy culture full of SH has damaged the brand, allowing rival Lyft to steadily grab market share, although Lyft is really, business-wise, no better than Uber. That Uber's rideshare business grew revenue by just 9% while the company lost more than $1 billion in its most recent quarter should be alarming. There's only one place for a no-growth, money-losing stock to go, and it's not up. The company needs to get its core ride-sharing business in order if it's going to have any shot at long-term success. So yeah, that's pretty much where it's well said. Now, I'm not going to say that Uber should cut Uber Eats Go. Obviously, they should keep it, and they should try to expand it because, again, this article does say that, that it's making money. They're doubtful it can grow, but it's making the money for the time being. I think it can grow. I think it can grow a little bit more than what it is now. However, as long as the ride sharing is still like more than 50% of their business, if that's failing, it's always going to be an anchor to the company. So Uber needs to, I think, expand the Eats business, maybe get the advertising thing down. They need to stop spending so much money in autonomous cars and flying cars that aren't actually going to go anywhere, like California's bullet train. So that's where we're going to leave that there. What do you folks think? Do you think there's a lot of room for Uber Eats to grow? Do you think, it's kind of capped? Do you even like delivering for Uber Eats, or do you prefer delivering for one of the other food rideshare platforms? I would love to know. So comment below, like, favorite, share, subscribe. If you enjoy my videos, consider becoming a Patreon member. It's totally optional, of course, but even as little as $1 a month goes a long way to helping the channel run smoothly, and you get access to my Patreon's exclusive blog. Also, if gas prices are getting you just a little down, check out the Get Upside app below. It's totally free, but you get cash back on every gas purchase. If you want more content from me, subscribe to the Apptrepreneur Vlogs channel. It's different from what I normally do here. However, we have more content there if that is your thing. And finally, if you want to talk to me or other fellow rideshare people, check us out at the Apptrepreneur Hangouts on Facebook. And as always, flame responsibly. Have a good one.